Good morning, and thank you for joining us today for the webinar Secure 2.0, What You Need to Know, presented by Ray & Associates. My name is Becky Wyan, and I will be moderating today's session. Before we get started, there are a few housekeeping items to cover. If you have any questions during today's presentation, you may enter them into the chat box on your screen. We will try to answer as many questions as possible at the conclusion of today's presentation. However, to be respectful of your time, we may not be able to get to all of them. So therefore, following today's webinar, we will review all questions and send out answers via email as soon as we can. Today's webinar is going to be given by Paul McEwan. Paul is a principal at Ray & Associates, and he leads the firm's retirement plan consulting administrative services team. He is responsible for consulting with clients on fiduciary best practices related to their qualified retirement plans. And with that, I'll go ahead and pass it to you, Paul.
Thank you, Becky. Good morning, everybody. Thank you very much for taking some of your time this morning and spending it with us. I started putting this information together right after the Secure Act passed back at the end of last year, and have had multiple conversations with advisors and with plan sponsors and clients since then. And I've attended dozens of other providers' presentations on Secure, and I think what I've tried to do is boil down what I think are some of the more important provisions of Secure 2.0 for us to kind of discuss and go through today. The audience today is primarily our existing clients, plan sponsors that we work with, as well as the plan advisors that we collaborate with in serving all of you. So I think it's going to be good information for everybody as we begin to kind of absorb and figure out how the Secure 2.0 Act is going to impact the industry and our plans going forward. Next slide, please, Kate. So just some general comments up front, just to kind of set the stage for Secure 2.0 and the information we're going to go through. Secure 2.0 is a huge piece of legislation, over 90 separate provisions, and that was just the retirement plan provisions. It was part of an Appropriations Act, a larger Appropriations Act, passed at the end of 2022. And most of the provisions are optional in Secure, and that's created a lot of confusion, at least early on. And so we've got a lot of questions from advisors and from plan sponsors about what do I need to do? And so the need to do's that's a pretty small list, but I've got highlighted in red the things that are optional versus required. We'll cover some of the required things, but most of what we're going to talk about today is optional. The other thing that's confusing everybody with Secure 2.0 is the timeline. Most pieces of legislation, when they're passed, are effective relatively quickly after passing, or immediately upon passing and becoming effective. This one has some rolling effective dates, and so I think it's helpful. I've found it helpful in having these discussions to kind of put things in chronological order in terms of when they will become available as plan design features as we move forward, so that you don't feel like you have to absorb all of this immediately. And in fact, we are waiting on additional guidance for some of these provisions, because many of these provisions, in my mind, to my way of thinking at least, are really kind of mind-blowing things that I didn't even think we could do. And so the industry is really struggling to catch up to the legislation in terms of what do we need to do to keep track of participant accounts and actually execute and implement some of these mind-blowing ideas and opportunities, I'll put it that way. But as I said in the middle bullet there, now's the time to start having these discussions. I'm hoping that through the discussion today, you begin to think strategically about your employee group what makes your employee group unique, what opportunities there are within Secure 2.0 for you to improve the employee experience with respect to the 401k plan. How do you make your 401k plan more competitive compared to your competitors? And maybe what you take away from the conversation today is, okay, that's part of Secure 2.0. I don't think that's really relevant to our group, and I don't even need to worry about that anymore. I don't even need to consider that. Let's see, timing of the document. So the next question we got, a lot of plan sponsors, clients have been very nervous about how quickly do I need to implement these changes into our plan document. As you know, every qualified plan has to be reduced to writing. And so your operations, your plan operations need to be reflected in the writing of your document. And so getting your documents updated, amended, restated, whatever word you want to use, is important. But again, these provisions got dropped late in 22, and the industry is still trying to catch up. So what most record keepers and TPAs do for documents is what's known as a prototype document. Those have to be IRS approved, and there's a process that that we have to go through to get that language. So don't look for amendments and restatements related to Secure 2.0 from us or from any other provider until the end of 2025. That's when documents will need to be updated to incorporate whatever of the provisions of Secure 2.0 that you want to implement. That doesn't mean you can't implement these changes until 2025. You will implement according, as these things become available on the timeline we'll discuss, you'll implement them in operation, but they just won't be reduced to writing until probably the end of 2025 or at some point during 2025. So the trick is going to be, depending on which provisions you pick and choose, because many of them are optional, we'll need to make sure, whoever you work with is going to need to make sure they keep track of the ones that you adopt so that we can get those properly documented within your document in 2025 when the prototype documents and amendments become available. And as I said before, all of this, as you'll see as we go through, there are a lot of questions. In many cases, we have more questions than answers at this point. So stay tuned for additional guidance. We're expecting a tranche of additional guidance to come through from IRS and DOL, probably as early as this month, but probably more realistically sometime during the summer. Okay, can you go to the next slide, please? So there's only one provision that is immediately effective. It was effective as of the passage. So back to 2022 and certainly in 2023. And that was what I have been referring to as the Rothification of the employer contribution. And this was, frankly, this was something that I didn't even think was possible in the traditional way of thinking. So what we're talking about here is the match and the profit sharing contributions that plan sponsors make to their plans, and to try to turn those into a Roth contribution. So as you know, when you make a Roth contribution, whether it's to an IRA or to the 401k plan, you're making those on an after-tax basis. And the advantage is when you pull those contributions out, they're not taxed in retirement. The earnings aren't taxed, and obviously the contributions, because you didn't take a deduction when they went in, they're not taxed when they come out. And I understand how that, that all makes sense. And the fact that you don't get a pre-tax deduction, payroll deduction, when you put that money in makes sense. It's an employee contribution. The idea that an employer can make a non-tax deductible contribution on behalf of the employees was just a little mind-blowing to me. And I wasn't quite sure how it was going to be implemented. Some of those questions have been addressed in the legislation, but there are a lot of others that have not been addressed yet. And so we're really advising everybody in the retirement plan community, whether they be plan sponsors or advisors, to really not try to implement, even though it's available now, and you could do a Roth employer contribution for 22 if you wanted to. Your record keepers aren't ready to record keep it. And frankly, there, as you'll see, there are more questions than answers as far as this goes. So really encouraging everybody to take a step back and let's get some more guidance before we really see how this is going to work. So what's going to happen here is the employer is still going to get the tax deduction, which is obviously one of the big reasons for having a 401k plan in the first place. If you can't deduct employee benefits, that's a problem. You need to have that incentive, that tax incentive to bring these benefits to your employees. So that's going to remain intact. What is optional, and again, you see in red, this is an optional provision. So it's up to the plan sponsor to decide if they want to do this or not. And it's not going to apply to every employee. So each employee then will decide whether they want to receive that employer contribution in their account on a pre-tax basis. And why is that important? That's important because when you make an after-tax contribution to your employee's account, whether it be through the match or through some sort of non-elective / profit sharing contribution, it's going to increase their taxable income on their 1040, and they are going to have a tax liability. So just saying that is probably enough for you to begin to understand where the complexities might be with this new provision. So the first thing I have listed on this slide is this is only available. First of all, the plan sponsor again has to adopt this, but it's only available to employees that are fully vested at the time of the contribution. All right, so if you have some sort of vesting schedule associated with these contributions, whether they be match or profit sharing, then some of your employees are going to be eligible to do this and some are not. Can you next slide, please, Kate? So the devil is in the details on this. We don't know how the tax withholding is going to work, and we don't know how the tax reporting is going to work on these contributions. So it's possible that these contributions will be added to the W-2 and reported. If we add them to the W-2, are these employer contributions now going to be subject to payroll taxes? Payroll taxes have an employer liability component and they have an employee liability component. I don't think that was the intent, but we don't know. That wasn't addressed in the legislation. The alternative is the record keepers could report these on a 1099-R. That would be similar to the way an in-plan Roth conversion works right now. So if your plan allows for in-plan Roth conversions, and frankly, that's at the bottom of this slide, that's a workaround for this whole concept right now. If your plan allows for in-plan Roth conversions, you can take a portion of your pre-tax money and convert that essentially into a Roth contribution. And when you do that, the record keeper issues at the end of the year a 1099-R to the participant, and that income that's reported on the 1099-R is then picked up on their W-2, or excuse me, on their 1040, and obviously there's a tax liability that's going to be associated with that. So I think what we want to avoid here is surprising employees with unexpected tax liabilities early in 2024 related to their 2023 taxes. Record keepers are also scrambling. They're going to need to create a new source to track these if you decide you want to add this to your plan. If you don't already have a Roth source, you're going to have to add a Roth source in order to accommodate this. So as I mentioned before, a possible workaround that you could do now if you wanted to implement this, instead of choosing to add this new Secure 2.0 provision, is just allow your employees on a voluntary basis to convert some of their pre-tax money or all of their pre-tax money in your plan into a Roth account. And they can, it's not an all or nothing thing. You can convert a portion of your pre-tax money over a number of years if you want to kind of digest that tax liability over a number of years. So that's a very viable and the record keeping process, the plumbing, if you will, is already in place, and the reporting is already in place to accommodate that. So and as the last bullet point there, when you do an in-plan Roth conversion, those are not subject to payroll tax. They're just subject to income tax. Next slide, please. So just as you're beginning to strategically think about this, if this is intriguing to you, how are we going to execute this in terms of participant elections? Are we going to do this electronically? Are we going to do this in paper? How are we going to educate participants? I think this adds a lot of complexity. It's one more thing for your employees to think about. When we added the ability for employees to make Roth deferrals several years ago, a lot of advisors were concerned about how much the complexity that provision by itself added to the education process for participants. So now we're layering on yet something else for participants to think about and understand how this is going to impact them from a tax perspective. You're going to have to track fully vested versus partially vested. So which of your employees can make these elections. And we're going to have a process for withholding and remitting withheld taxes. I think that should be a fairly easy process, but I don't know how that's going to work because we don't know how the reporting is going to work. So that's it on that particular provision. So the next group of provisions that we're going to talk about are effective in 2023. Next slide, please, Kate. The next few bullet points I think are a little bit quicker to get through than the Rothification of the employer contribution, that whole concept. One nice thing for those of you that have SEPs and simple IRA plans, one of the knocks, one of the disadvantages to having a simple IRA versus a qualified 401k plan was that employees could not do Roth contributions to a simple IRA. That's primarily because of the way that simple IRAs are funded using individual IRA accounts. This legislation, Secure 2.0, adds the ability for employees to make Roth contributions to a simple IRA. I have no idea how that's going to get executed. So again, it's going to go back to the custodians and the record keepers in the simples to figure out, are we going to have two separate accounts for everybody now, or at least those that are electing to do simple contributions? Where is the match going to go? Is the match going to go, is that going to be pre-tax? Is that going to be Roth? Are we going to try to record keep within a single account, the Roth after-tax money and the pre-tax money? We don't know. You're going to have to wait. For those of you that have simple IRA plans that are interested in this, you're going to have to wait to get that information. And I'm sure the record keepers will reach out to you when that information becomes available. And it's a high priority, and it'll come out hopefully sooner than later. The next item on the slide is just a heads up. The part of the Secure 2.0 wanted to address the longer lives, the more time we all are spending in retirement, and so it's pushing out the required minimum distribution age to 73 starting in 2023. Secure 1.0, which was passed back in 2019, increased the RMD age from 70.5 to 72. Secure 2.0 pushes it out to 73, and actually in 2033, so 10 years from now, Secure 2.0 envisions and plans on having an RMD age increase to age 75. So I think that's good news actually for those in retirement. Next slide, please, Kate. Go back real quick, Kate. I just wanted to point out the RMD age increase, that is required. The SEPs and the simple, if adding the Roth contributions to simples, that's an optional. So again, hopefully you guys are picking up where I've indicated optional versus required. Next slide. Thanks, Kate. So I'm not going to spend a whole lot of time on this because I think with this audience, most of you already have plans in place, but Secure 2.0 kind of tweaked an existing credit that was out there for small plan sponsors to really create an incentive for them to add 401k plans or SEPs and simple plans and offer them to their employees. A big goal of Secure 2.0 is to get greater coverage of qualified retirement plans or employer-based retirement plans offered to employees. There's a very large percentage, and I don't remember what it is, but it's probably somewhere around 40% of all employees in the country don't have access to a workplace retirement plan. So this credit has been helpful in the past, and Secure 2.0 kind of beefs it up. The first part of the credit is really a 3-year credit on the administrative costs of offering a plan, which is nice. You have to have fewer than 100 employees to qualify for any of these credits. So the first part of the credit is really, I'm not going to go into the details, but if this applies to you, feel free to follow up with me or your advisor, and we can get you more information about how to calculate the credit. But the first part of the credit deals with covering the administrative costs. If you go to the next slide, Kate, the second part of the credit, which is brand new. So that last part of the credit was previous to Secure 2.0 covered 50% of your administrative costs. Secure 2.0 increases that credit up to 100% of the administrative costs. So really gets rid of all the costs associated with starting a 401k plan, which is very nice for small employers. This part of the credit makes it kind of a no-brainer, because the next part of the credit actually reimburses, provides a dollar for dollar reduction in your tax for plan sponsors implementing new plans to cover the actual contributions to the plan, up to a per employee cap of $1,000. And again, I'm not going to get into the details of how we calculate this credit, but it is going to be a fairly complex calculation, and you're going to need to calculate it per employee. We're used to dealing with employee census as third-party administrators, so I would tell you to reach out. If this credit applies to you, reach out to either your CPA or your third-party administrator for help calculating this credit, because it is fairly complex. Some of the things that I just wanted to point out: there's no credit available for any employee whose FICA wages exceeded 100,000. So again, they're trying to target the credit to non-highly compensated employees, which hopefully is the vast majority of employees out there. So I don't think that's going to be much of a reduction in the credit, but you do need to be aware of that. And then the same target of the credit to employers with 100 or fewer employees. You need to be aware of that. So you get the full credit if you have fewer than 50 employees. If you have somewhere between 51 and 100 employees, it begins to phase out 2% per employee over 50. And then the credit is phased out over a period of 5 years. So the first 2 years, it's 100% of contributions up to that $1,000 per employee. And then after that, it's 75% in year 3, 50% in year 4, and 25% in year 5, then completely phased out after that. One thing that some of you might be wondering about is if I've got a SEP or a simple plan in place and I switch to a full-blown 401k, is that a new plan for purposes of this credit? And the answer is no. What they're looking to do is to get employers that don't have any plan at all to sponsor a plan, and that can be a SEP, a simple, or a 401k. So if you've already got a SEP or a simple in place, just converting your SEP or simple to a 401k is not considered a new plan for purposes of this credit. So you just want to make that point as well. Next slide, please, Kate. Just real quickly on this one, it used to be that the 401k rules prohibited employers from providing financial incentives to their employees to sign up for the 401k plan. What this new law allows is a de minimis financial incentive. As long as you're not paying for these incentives with plan assets, you can give a gift card, for example, up to $25. $25 or less is really considered de minimis. At least that's what we think at this point. We'll need some additional guidance, but I think you'll be pretty safe if you go with that. I don't really know. This isn't something that we talked much about with clients, so I don't really know what the appetite's going to be for this. My thought is automatic enrollment would be a much more effective. If you're concerned about employees not participating in your plan, automatic enrollment is going to be a much more effective option than a gift card. However, if you don't have automatic enrollment, don't just click the box and add automatic enrollment. That is a fairly complex, that's a big change to your payroll processes and the integration between your payroll information and your record keeping information on the plan. That all needs to be worked out and thought out before you add automatic enrollment. I'm a huge proponent of automatic enrollment, but it needs to be done well. If it's not done well and in a very controlled way, it's very easy to miss employees that should be automatically enrolled, and then you end up in situations where you have to do correction programs with the IRS and the DOL, and it becomes very disruptive to your operations, and you can end up paying penalties. So automatic enrollment is a great feature, but for small employers in particular, it's something that really needs to be thought out, and that's something that we're actually working a lot with our plan clients right now. So if you have any questions about automatic enrollment, let me know. But I think it's a much better way, much better incentive, a much better process for getting folks into your plan, be much more powerful than this de minimis financial incentive. Next slide, please, Kate. And this is that was all optional as well, as you could see. So the next series, so that was all 2023. The next series of changes are all available in 2024. So they're not available yet. Next slide, please. So I'm really intrigued with this emergency savings account opportunity. So what Congress is trying to address here is the problem that many Americans have building up an emergency savings account and trying to automate, if you will, the process of creating an emergency savings account and utilizing the 401k plan as that vehicle to accumulate some emergency savings. Historically, 401k plans have been terrible places to pull money out in the event of emergency because generally speaking, historically, all the contributions go in on a pre-tax basis, and when you start pulling money out, you subject yourself to penalties, 10% penalty, and taxes, both federal and state and local taxes on those distributions. So it's not been a great way to pay for emergencies, let's just put it that way. And so Congress wanted to address that and come up with a solution for participants, employees, to be able to, while they're saving for retirement, also create a small emergency savings account. Record keeper, this is a huge lift for record keepers. So that's why 2024 was the implementation or the effective date for this particular provision. I think they'll be ready to go, but don't look for information on emergency savings accounts until closer to the end of 2023 if this is something you're interested in. Again, this is an optional provision, and the way this is going to work is these have to be Roth contributions. They are after-tax contributions because we don't want to have a situation where an employer or employee puts money into an emergency savings account, when they pull it out, it's subject to penalty. So these have to go in as Roth contributions. So if you don't have a Roth source, you need to add a Roth source if you're going to add emergency savings accounts. The new emergency savings accounts are limited to $2,500. So what happens is once an employee reaches that $2,500 limit, any extra contributions are going to become Roth source. They're going to go into a separate source in the 401k plan automatically. That's not anything that you have to do or the employee has to do. Once they hit that $2,500, obviously there'll be some earnings that go on into the $2,500, but they won't be able to contribute any more dollars once the balance is at least $2,500 in their emergency savings. Employer contributions cannot go into the emergency savings accounts. They have to go into the match source or the non-elective source that you already have set up. Let's see, is there anything else I want to talk about? The plan can establish additional eligibility requirements. I'm not sure what those are going to look like. One of the things, the last bullet point down there, highly compensated employees are not eligible to create emergency savings accounts. An emergency or a highly compensated employee is defined as anybody for 2023, anybody making more than $150,000. And so anybody that made more than $150,000 in 2023, in 2024, if you add emergency savings accounts, they won't be able to start an emergency savings account. And these savings accounts were not really designed with highly compensated employees in mind anyway. So I don't think that's necessarily a bad thing. Next slide, please, Kate. So what happens if a non-highly compensated employee becomes a highly compensated employee? Now, they'll no longer be able to make contributions to their emergency savings account. Their emergency savings account doesn't go away. They can continue to take money out of it, but they can't continue to add to it. I already mentioned withdrawals when they come out of these emergency savings accounts won't be subject to the 10% premature distribution penalty, and they won't be subject to income tax. So it really will be very similar to pulling money the way you would pull money out of a savings account or a checking account in a bank. The participant has complete discretion over the withdrawals. The record-keeping industry was really worried about opening up the floodgates of a lot of different transactions being added into the system, and how are they going to pay for that? So what Secure 2.0 mandates is the first 4 withdrawals for the year are free, and then after that there has to be a reasonable fee is allowed to be billed, but they don't really define what reasonable is. So time will tell in terms of where those fees end up. But the first 4 do have to be free for employees pulling money out of their emergency savings. And there's no, you might be familiar with the concept of hardship and having to have a financial emergency. None of that applies. This really is, they don't have to have a certain emergency. That if they need to put tires on their car, anything applies. You don't have to attest to any sort of emergency. This is just another savings account. Next slide, please. Let's see, I think I might have covered some of this. If you have auto enrollment and you're doing emergency savings, and I don't quite understand why this particular provision was added to Secure 2.0, but the auto enroll deferral amount can't be more than 3%. You will have to add, all of these disclosures, additional disclosures, and explain how these emergency savings accounts work. So that's some additional complexity for participants to understand. We're going to need to add these provisions to your plan document. There is going to be a separate record-keeping source, as I said before. Interestingly, the investments are going to be limited to just interest-bearing accounts, so you're not going to be able to use equity or fixed income types of investments in these emergency savings. So that's something else, that the record keepers are really focused on, because that's a limit or a feature that has to be built in. So you're going to be limited the types of investments. It's going to basically be money market, or if you have a stable value type of fund available in your plan, that would qualify as well. It just has to be something that isn't going to go up or down in value. Let's see. Yeah, I think I covered the last point already. So next slide, please, Kate. So this next provision is also optional. I think this is a good alternative to emergency savings accounts. Really just depends on the demographics of your employee group. But if you want to make it easier for employees to get money out of the plan without going to the all the complexity we just talked about with emergency savings accounts, you can add an emergency distribution provision starting in 2024 to your plan that will essentially allow for any financial emergency. So it doesn't have to be financial mortgage, foreclosure or rent or medical expenses or educational expenses. All of those safe harbor reasons for financial hardships don't apply. But employees will be able to take up to $1,000 a year out of their account. The 10% early distribution penalty won't apply. They do need to self-certify that they have an immediate financial need, so a little bit different than the emergency savings account, but again, not limited to specific reason or the safe harbor reasons that you're used to thinking about in terms of hardship withdrawals. There is an opportunity, which I think is nice, if once the financial emergency is passed, if the employee wants to repay the emergency distribution amount, they can do that. They have up to 3 calendar years to get that paid back in. If they don't repay the amount, they're limited to $1,000 each 3 years in terms of pulling money out of their account. So this is a fairly limited option, but it's meant to address the concern by employees that if I join the plan and if I put money into the plan and I don't have a large emergency savings account or any emergency savings account, I won't be able to get that money in the event of emergencies. And it was, it's always been a barrier to participation. So it's supposed to, knock down one of those barriers to employees actually participating. So I asked the question there at the bottom of the slide, is this a good alternative to emergency savings accounts? I think you will have to think about that and decide if, and you can add both of these. It's not one or the other. You can do both if you want, but if you don't want to go to the complexity of the emergency savings accounts, I think this is a good alternative. Next slide, please, Kate. Catch-up contributions are now going to be required to be Roth. This starts in 2024, but this is only for employees that make more than 145,000. I don't know how they came up with 145,000. It's not related to anything else. Whoops, here we go. So this isn't, so if you don't have a Roth source in your plan, you're going to have to add it if you want to have the ability to do catch-ups. In my experience, it's mostly just highly compensated employees that are doing catch-up contributions. In those situations where we recharacterize normal deferrals as catch-up to prevent corrective distributions in a failed ADP or ACP test situation, I don't know how that's going to be done. I mean, that's one of the, we need guidance in terms of how we're going to, that's one of the things that the record keepers are wrestling with. How do we reclassify contributions that might have gone in pre-tax, and now we're reclassifying them, and the individual is a highly compensated employee, so it has, when it's reclassified, it has to be reclassified as Roth. How do we do that, and what's the impact? So we're waiting on how that's going to work. Trying to think. Arguably, this excludes self-employed. So the law specifically talks about this $145,000 being FICA wages. We're waiting on, I think we'll get some additional guidance. I think there's an argument that can be made right now that if you're self-employed and you sponsor a plan and you don't have FICA wages, that you basically use your self-employment income as a basis for contributions to the plan, that this doesn't really impact you. But we'll see. That seems too good to be true to me, and maybe not what Congress intended, but we'll see if we get any additional guidance on that. And this does not apply to SAR/CEPs or simple IRA plans. This just applies to qualified 401k plans. Next, and this is a required contribution. So you can see there, this is required in red. Next slide, Kate. This is something that we've really been asking the IRS to allow for a long time. And it's because as our clients grow, they generally, oftentimes they'll start with a simple IRA plan because it's so simple and inexpensive administratively. But at some point in their life cycle, they will want to go to a full-blown 401k plan. And it's always been a real pain in the neck, excuse me, to convert a plan from a simple IRA plan to a full-blown 401k plan, because there was a rule that essentially said if you had a simple IRA plan, that was the only plan you were allowed to have for the entire year, the entire calendar year. Secure 2.0 gets rid of that rule. And essentially now, as long as you go from a simple IRA to a safe harbor 401k, which is by far the most common pathway for our clients, as long as you go from a simple IRA to a safe harbor 401k, and that can be a QAGA or a simple 401k, although we don't do a lot of simple 401ks, you can convert mid-year. Now, if you go away from a safe harbor type of arrangement where you're making match contributions fully vested, then you're gonna have to wait until the end of the year, just like you've always had to do. But it's always been just a pain in the neck. You have to notify participants that you're terminating the simple plan, and then you have to notify them that you're starting the safe harbor plan. There's notices that have to go. So it's just confusing, and it's a lot of paperwork, and it's just a hassle, and it all has to be done right around the end of the year, the end of the calendar year, and it can be kind of a bit of a pain in the neck to do that. So this, I think, is kind of a nice operational change, and should make it a lot easier for our clients to go from a simple plan to a full-blown 401k. If you're wondering, well, what do I do? You know, the simple deferral limits are different than the 401k deferral limits. How's that going to work? You know, that'll just be prorated by day. So if, let's just assume you had a simple IRA plan for 6 months and then a 401k plan for the last 6 months of the year, you would just prorate the deferral limits between the simple and the 402 based on the days each was in place. So it's just kind of a mathematical calculation. I think that makes sense to me, and kind of addresses that issue. And then, you know, what happens to the simple IRA balances, the IRA balances? You can roll those into the 401k with the restrictions, of course. If you started making contributions within 2 years, those restrictions will carry over into the 401k plan until they expire. The cash out, the last bullet point there, cash out distribution limit, that's going to be optional, but there's no reason in the world why you wouldn't do that. That's where you have the ability to push out small balances, small vested balances of terminated participants. Right now, that limit is 5,000 for balances 5,000 and below. You can kind of push those out. And many of our clients go through that process every year just to minimize the number of small account balances in their plan. In 2024, that limit goes to 7,000. So I would expect, it's kind of a no-brainer, we would just automatically implement that for most of the plans that we work with. Next slide, please, Kate. Go back real quick. Yeah, auto portability, not gonna spend a lot of time on it. That's a concept that Congress wants to prevent leakage from the retirement plan system, and so they'd like to be able to connect databases between plan sponsors so that if somebody leaves your workforce and goes to work for somebody else down the street, that their 401k can automatically go from your plan to the plan down the street. There's a whole lot of technology that has to happen before this is going to become a reality. You may see some things being advertised. I've already started to see auto portability being advertised, but when I've actually followed up on it with the provider, they're quick to point out that, you know, this isn't something that is ready for prime time yet. We already have a process in place where you can push small balances out into rollovers. It's called the auto rollover process. All of our clients have that ability. That we build that in. So we have a process for getting rid of small balances. So it'll be nice when when technology is there to do this, perhaps, but you don't need to worry about it too much at this point. RMD is not required. So the last bullet point there is just kind of putting 401k plans on parity with Roth IRA accounts. For a long time now, Roth IRAs don't have required minimum distributions associated with them, but Roth 401k plan balances did. All Secure 2.0 does is say Roth 401k plans no longer have RMDs associated with them either. This is a required change, so we will automatically be incorporating this into your plan in 2024. Next slide, please. Starter 401k, most of this audience probably already has a plan in place. I don't think we're going to be doing much. This is another optional provision. I don't think we're going to be doing much with these plan designs. What this is a deferral only 401k plan with a maximum deferral of $6,000. You know, you can just do an IRA if you want to. I think what Congress intended, this was supposed to be kind of an easy way for an employer that is in a state that has a mandated IRA, state mandated IRA program. So if they don't offer a 401k plan, they have to automatically contribute to an IRA for their employees. I think this was meant to kind of replace the state mandated IRA program. We don't have state mandated IRAs in Ohio, so I really don't think this is going to be of much use, or it's not going to be very attractive to any of the clients that we work with. But if you have any questions about it, I'm sure we can answer those questions as you have them. Next slide, Kate. I think this is a big, I do want to spend a little bit of time on this. This is available starting in 2024, student loan matching. So, and again, another big barrier for employees not participating in 401k plans is because they have large student loan payments and they don't feel like they can contribute both to the 401k and make their student loan payments on time. So what this allows employers to do, this is optional, don't have to do it, but if you have a large portion of your workforce that is coming to you with student loans, you can give them credit for making those student loans and match those student loan payments in the same way that you would match contributions to your 401k plan. And it's really as simple as that. I think the devil is in the details on this. We're waiting for some additional guidance. You know, I think we've got some really good reporting out of the student loan servicing market. So there's a lot of good reporting that goes on right now back to students that have student loans in terms of what, you know, what payments are they making during the year. So I think it'll be easy for them to document the payments that have been made, but obviously they're not making these student loan payments through payroll deductions. So employers aren't necessarily going to know what payments they're making during the year. So what I envision, at least initially, is there's going to be self-certification of these loan payments. It's going to happen at the end of the year, and you're going to make match contributions at the end of the year, one time, once you've gotten the, the substantiation on the loan payments that have been made. And all the match and deferral limits apply here. So you're really just, what Congress intended was, instead of making a contribution to the plan, let's give the student or former student who's making, paying off those student loans, let's give them credit as a deferral, and let's match those payments and make a contribution so that they can begin to accumulate a balance in the 401k plan, even though they aren't able to actually contribute out of their own pay yet. Next slide, please. So this is 10% higher deferrals for some simples. I don't know if this is going to be attractive to clients that utilize simples. I would say if you're really wanting to defer more, it's probably, you might as well do a safe harbor 401k, but Secure 2.0 does allow a 10% higher deferral rate for simple plans. It's automatic if you have 26 or fewer employees. Once you go over 25, so 26 to 100 employees, it's optional. If you choose to add these higher deferral rates, then you do have to increase. So this is for larger employers, larger being defined as 26 to 100. Once you go over 100 employees, you're no longer eligible to do a simple. So just making sure everybody understands that. But for those larger employers that have simples and they want to increase the deferral limits, if you do that, you have to increase your match to 4%, or if you're doing a non-elective, you have to increase it from 2% to 3%. Next slide, please. Additional non-elective for simples. This is something I think is a nice add. I don't know how much it's going to be utilized. Historically, if you had a simple IRA plan, you couldn't do a profit sharing contribution. So those things, you could do a non-elective contribution or a match, but you couldn't, at the end of the year, decide to do a profit sharing contribution. Secure 2.0 allows you to do a profit sharing contribution. You have to do a pro rata allocation based on compensation. That's the only way to allocate your profit sharing, and you can only contribute up to 10% of comp. You can't do more than 10% of comp. And you're limited, just like you are on a regular 401k plan or in a simple plan. You can't consider compensation above $330,000. That makes sense to me. All eligible employees with at least 5,000 in comp have to be included in your allocation if you're going to do this. Again, it's nice. Occasionally we have clients, tax clients, they get to the end of the year, they've got some additional profitability they've accumulated, they had a good year, they've got some cash, they'd like to reward the employees. In the past, there wasn't really anything they could do through the simple plan. Now they can add additional contributions to the simple accounts for their employees if that's something that they're interested in doing. Next slide, please. So these are effective in 2025. Based on the audience today, I don't think we have anybody that's implemented a plan after the end of last year. But if you did, automatic enrollment is now required for any plan sponsor starting a new plan after 12/29 of 22. So if you already have a plan in place, your plan is grandfathered, you do not have to add automatic enrollment. This has been a little bit of confusion for clients concerned that they would have to add automatic enrollment. There may be other reasons why you would want to add automatic enrollment, but you are not, if you have an existing plan, if you had a plan prior to 12/29 of 22, you do not have to add automatic enrollment. If you start a plan after 12/29 of 22, you do have to have it. The complexity here is you don't have to implement your automatic enrollment in this year or next year, but you do have to implement it in 2025. This gives you a little bit of time to kind of figure out, again, how's that process going to work with payroll so that we make sure we're not missing anybody who becomes automatically enrolled. But just want to make sure everybody understands, if you've got an existing plan, your grandfathered automatic enrollment does not apply to you. Now that yeah, I don't think we need to really talk about anything. Oh, there is another exception. I just want to make sure everybody understands. If you have fewer than 10 employees, you're a very small employer, and you're also exempt from the automatic enrollment requirement. Again, Congress felt like for very small employers, executing automatic enrollment is a heavy administrative lift for them, and so they exempted very small businesses. Next slide, please. Real quick, this is a continuation of Secure 1.0 that passed in 2019. Long-term part-time employees are defined as those employees that are working for you more than 500 hours a year, but less than 1,000 hours a year. So most qualified plans have eligibility that requires at least 1,000 hours of service in a year to be eligible for the plan. So what happens to those gig type employers, those long-time part-time employees that never work more than 1,000 hours a year? They never become eligible for the plan. They never have the opportunity to defer. Secure 1.0 said if you have somebody in that situation and they're with you for at least 3 years, the 4th year, you have to allow them to defer into your plan. You don't have to match, you don't have to give them profit sharing, but you have to allow them to defer into your plan. Secure 2.0 just shortens that 3-year period to 2 years. That's really all I'm going to say about that. Next, and then that is a required change. Yeah, next slide, please. Catch-up limit is increased for participants attained, and this is an optional provision. So for those employees that are 60, 61, 62, or 63, they're really close to retirement. Congress thought it would be a good idea to allow those employees that are really close to retirement to do an increase, to do an extra contribution to the plan. But again, you have to be within that age time frame in order to be able to make those additional catch-up contributions, which are listed there. So it increases the limits to the greater of 10,000 or 50% of the regular catch-up amount. So based on the 2023 limit, in those 4 years, catch-up would be $5,250 for simples and $11,250 for other plans. And then that's going to get indexed after 2025. So again, that's optional, and it becomes optional in 2025. And I would imagine for most employees, they're going to want to do that. That are going to want to do this. They're probably over 145,000 in comp, and those will end up being Roth contributions. Next slide, please. So effective in 2027, just one optional provision here that I wanted to cover. This is a savers credit. This already exists. The match is 50% of the amount of the contribution to an IRA, or $2,000 per individual, with a maximum match of $1,000. We're already doing this. This is for employees that are relatively low paid. You can see the bullet point down there. The match phases out between AGI of 41,000 and 71,000. For joint filers, 20,500 to 35,500 for single filers. We don't have a lot of employees or participants that take advantage of this. Right now, those that are eligible get a credit on their 1040, and it's part of their refund. Starting in 27, those are required to go either deposited direct to an IRA or direct to a qualified plan. We don't have the technology to do this right now. That's why Congress put this out in 27. Plan can choose not, your plan will be able to choose, it's optional, so you can choose not to accept these savers match contributions. So it'll just be interesting to see how this develops, but you'll be learning more about this opportunity from your record keeper in the future. I think that was pretty much it in terms of my slides. Yep. So, and we're finished up. It's 10 o'clock. Thank you very much for your attention. If anybody has any questions, I'm happy to take them now, or Becky, I don't know if you want to, we can do an FAQ, and we can address those questions in the form of FAQs when we send out a copy of the slides. Is that what we want to do, just to get people
Yep, that works well.
Okay,
Yeah, we have a couple questions, so we'll get Paul to answer them and we'll send them to you in the follow-up email. But feel free to reach out to Paul or us if you have any additional questions that may come up later on. Thank you, everyone.
thank you very much, everybody.